Okay.
Okay. Good evening to all. This is the special lecture program for undergraduate students organized by Kolkata Bidhannagar Society for Academic Advancement, West Bengal, India, coordinated by Azure Academic Services, West Bengal, India. Today's topic of discussion is marginal costing, and today our guest faculty is Dr. Samrat Banerjee sir. He is Senior Assistant Professor, Faculty of Commerce and Management, St. Xavier's University, Kolkata, India. Welcome, sir.
Thank you. Thank you for giving me this opportunity to deliver a special lecture on marginal costing. So, can I
Thank you
start
so
my
much.
session?
Sure,
Yeah.
sir. Thank you so much for your time. Please take over the session.
I hope that my screen is visible properly.
Yes, sir, visible. Please start.
So, hello everyone. Today I'll start with marginal costing. This is a very important chapter of the subject management accounting. Now, as we know that if we talk about costing altogether, the first thing that comes in our mind is cost, because cost means the amount of expenditure that we incur on any product or service. So basically, any expenditure that we are incurring on a day to day basis, on whatever may be, that is basically the cost of a commodity or a service. So I am moving forward. So first of all, I would like to declassify the difference between CVP analysis and marginal costing. Now the question comes up is that what is CVP analysis? Or sir, why are you starting off with this concept? Because whenever we study this chapter marginal costing, it is coming under the head of CVP analysis, that is cost volume profit analysis. So basically we'll see that whether they are subset of each other, one is the superset of the another, or whether there is any difference between these two concepts. So basically, as we can see, the CVP analysis is a basically a decision making tool which studies that if there is any change in the level of production. For example, if a company is producing 1000 units and if it increases its production level from 1000 to 1500 units, then what will be its impact on the cost? Of course, there will impact on the cost, right? If the production level changes. And overall, what will be the impact on the profitability of the organization? So this entire thing is being covered under CVP analysis. So based on this thing, CVP analysis helps the managers to take decisions by using the principle of marginal costing. So it is very, very, very important. So CVP analysis uses the concept of marginal costing to analyze the change of level of production on the cost and basically to find the overall impact on the profitability of the concern. Next, I proceed with the marginal costing, the basic concept of marginal costing. So as we can see over here, it is a method of basically recording the costs, classifying the cost into fixed and variable costs, and then valuation of cost to determine the cost of the product accurately. So if we see in simple words, CVP analysis is a decision making tool which uses the concept of marginal costing to determine or to analyze the effect of change in production level on the cost and basically on the overall profitability of the concern. On the other hand, marginal cost is basically a method which records, classifies the cost into fixed and variable portions, and then values the cost to determine the product cost accurately. Moving forward to the next slide. So I am basically entering into the subhead of marginal costing, which is basically the topic of our discussion today. Now, basically, what is marginal costing? So I will decode the word at first. What is marginal? And then I will go to the term costing. So marginal, as we see, as we are very much acquainted with the word margins. Whenever we start writing in a paper, we leave a certain portion. of the paper, and we leave a certain space or portion of the paper as margins. So that is a gap basically. So we are leaving an extra or an additional portion of the page, and thereafter we are starting writing. So basically, marginal means something extra or additional. On the other hand, if we talk about costing, it is basically a technique or a process of ascertaining cost, that what will be the cost of this product, what will be the cost of this service. So that method is called costing. So basically, marginal costing is a method which not only ascertains cost, but it ascertains the additional cost for additional units produced, additional level of production. So by combining these two terms, we are getting the term marginal costing. We are moving forward to the next slide. Now we are coming to a holistic definition of marginal costing. I have tried to give a lucid definition of marginal costing for the benefit of all the academicians as well as for the students. So basically, it is a method which allots additional cost, as I have already discussed in my last slide, for additional units produced. So basically, if a company produces 1,000 units, and for 1,000 units, the company is incurring a cost of 10,000 rupees. Now, a company increases its production by 1 unit. That is from 1,000 units to 1,001 units. So my initial cost was 10,000 rupees. So if my production increases by 1 unit, then supposedly, for example, if my cost also increases by 100 rupees, then that 100 rupees is my marginal cost, the additional cost for that extra 1 unit of production. So it is basically the method of allocating additional cost for additional units produced, where the marginal cost, which is basically also known as variable costs, play a significant role in decision making. So basically, in the marginal costing technique, we do not consider fixed cost as an important parameter of decision making, because marginal cost is basically known as variable cost. So all the decisions will be taken on the basis of the variable cost under the marginal costing technique. So it is a method which basically segregates costs into fixed and variable cost, which I have already discussed in the last slide. It not only records, but it segregates the cost into fixed and variable portions, and thereafter uses the variable component to determine the product cost, because only the variable costs are relevant for decision making. Thus, fixed cost is only a period cost. Now, what is a period cost? Fixed cost, as we know, it remains same even if the level of production changes. So whether a company is producing 1,000 units, or it is producing 1,500 units or 2,000 units, the, the fixed cost will remain same. Let us take an example like rent of a warehouse. It will remain same on a monthly basis. But it is very important to note over there that it will remain fixed for a certain time period. We cannot expect the rent to remain fixed for years after years. It might remain fixed for the year 2025 to 26. After 2026, again the rent will change. The rent amount will vary. So fixed cost is basically a short-run cost. It is fixed for short run. So basically, fixed cost is a period cost. So it will remain fixed only for a certain period of time. So it has no role in decision making. But on the other hand, variable cost is a marginal cost which have a significant role in decision making. This is basically the concept of marginal costing. Now, to understand marginal costing, the biggest problem over here is that people get confused with so many formulas, specifically in marginal costing. Why? Because there are different terminologies, along with that there are different formulas. So today in this session, I will try to explain all the formulas, and after that I will also try to give some methodologies with the help of which we will be able to not only remember the formulas, but also understand that how you are getting those formulas. Okay, so for that reason, we have a master table over here, master table of income statement. Now, whenever we hear about the term income statement, specifically of a business or of a company, the first thing that comes to our mind is that what is the basic source of income for a firm or for a company or for a business? The basic source of income for a business is sales, revenue from operation. That is why while drafting a P&L statement, that is PL account, as you know in simple terms, we start the P&L statement with revenue from operations, that is sales basically. So over here also we'll start the income statement with sales. So as we can see, the format of income statement is given over here. So we start the income statement with sales. Now, as we know, what is the primary objective of a concern? To earn profit, right? Now, from sales, how can we arrive at the profit? By deducting cost. Because we know from our childhood days that SP minus CP, selling price minus cost price, will give us profit. So basically, let us consider profit is similar to attaining moksha. Okay, so we have sales, we'll deduct certain portion of cost, and after that, after deducting few more things, we'll attain moksha. Okay, now whenever we talk about cost, normally it is segregated into two parts on behavioral basis: fixed cost and variable cost. Now, let us assume that a person is trying to attain moksha. So he has to leave everything, all the attachments of his life, and he has to go to a mountain, he has to attain salvation, he has to go for meditation to attain moksha, right? It is a very difficult task for a normal human being. So, from sales, what will be the first thing that will be deducted? The variable portion of the cost. So, let us assume in such a manner that a person will attain moksha only if he earns profit. For that, he has to leave away all his attachments. So, what is the primary attachment that we have in our life? Entertainment, friends, that is the primary attachment. So, from sales, if we have to attain moksha, we'll first of all deduct the variable portion because we know that entertainment, friends, these are certain things we have very few loyal friends of our life, right? Most of the friends that we have after a certain period of time, we'll just have a hi and hello conversation with them. So first thing that we'll deduct is the variable portion of the cost. So from sales, we'll deduct variable cost. Now, whom do we have in our life after we eliminate, or I shall say more precisely, that if we leave away all attachments of our friends, entertainment world, whom shall we have in our life? We shall have our parents, our relatives. So normally what we see, our family, our parents, they contribute. They contribute on our life. So from sales, if we deduct variable cost, we will get contribution. Why I am telling this? Why I am explaining this income statement in the form of a story, so that even if you try to forget this income statement, if you connect yourself with this story, you'll be able to remember all the concepts. So from sales, first of all, deduct the variable portion of your life, then go to contribution because your parents, your family always contribute to your life, right? Now, from contribution, if you really want to attain moksha, you have to leave away all the attachments of your life. All attachments, everything, your family, your parents, everything, unfortunately. So, if you have to attain moksha, if you have to attain profit, then you have to also deduct fixed cost, unfortunately. And finally, what you will get? Profit. This is the preliminary profit that we are getting for a company, which is also known as operating profit. As I have already said, preliminary profit for running the day-to-day operations of a business from the operations. Operating profit or EBIT or PBIT, earnings before interest and taxes, or profit before interest and taxes. Okay. Post that, as we can see in this component, EBIT or PBIT, we have this is before, this profit is before interest and taxes. So logically, we have to deduct interest at first and then tax. So we have to deduct interest. So let us again go back to the story. A person is detaching himself from his daily life, from his friends, from the entertainment world by deducting variable cost. Again, from his family by deducting fixed cost. Is attaining the basic level of moksha. Now he's trying to go to a mountain, to a hill for attaining salvation, for attaining moksha. Now, whenever he tries to go, he receives a call from various friends or various relatives that he has taken some amount of loan, some amount of money from them. So the person who is leaving, he says, "Okay, I'll give you back my money. So just now I am transferring it to you." So the other person, the friend says, or that person who has given him loan says that you have taken my money for so many years, or for so many days, or for so many months. So there is certain amount of interest accumulated on that. So you have to also give it to me. So he also gives up the interest amount. So from operating profit or EBIT, you deduct interest. Finally, you go to profit before tax because you have already deducted the I component, that is the interest component. It may be interest on loan, interest on debenture, interest on debt component, as we can see as we get in the case of a company. Now under profit before taxes, as we can also see it is before tax. So again, we have to deduct the tax component. This tax means the corporate tax for a company. So after deducting tax, what do we get? We get profit or earnings after tax. That is the moksha with respect to our marginal costing, with respect to our income statement. Now, if we need to calculate EPS, earnings per share, what is earnings per share? If I say I am calculating X per Y, that means X divided by Y. Similarly, if I say earnings per share, that means earnings divided by number of shares. So what is the latest earning that we have got? It is earnings after tax or profit after tax. So we will divide that with the number of equity shares. That is basically EPS, earnings per share. It is a very important parameter because with the help of EPS and market price per share, we can calculate PE ratio, price earning ratio, which is one of the important parameters in stock market. So basically, again, to recapitulate whatever we have done, we have till now, we have covered up the basic concept of CVP analysis, and CVP analysis uses the concept of marginal costing, then the definition of marginal costing and the concept of marginal costing by decoding the marginal costing into two parts, marginal and costing. Next, what we have done, we have gone directly to the income statement master table where we have seen a format that a business can survive if the business can sell. That is a basic source of revenue for a business. So from sales, if you deduct the cost, first of all, the variable portion of the cost, you will get contribution. Next, the fixed portion of the cost, you will get operating profit. Next, you deduct the interest, you get PBT. And finally, the taxation, you get PAT. And how to calculate EPS? PAT divided by number of equity shares. Now I am moving forward to my next slide. We have few formulas over here. I'll start with the first thing, that is method of calculating contribution. Before going to this method of calculating contribution, I would like to go to the previous slide once again. So as you can see, if someone asks me, or if someone asks a layman also, how to calculate contribution, how many methods are there? If you remember this income statement, that will be more than enough for you to find out majority of the formulas. How? First thing, sales minus variable cost will give you contribution. As we can see from the statement itself, sales minus variable cost will give you contribution. Second thing that we can observe from here is that if we deduct fixed cost from contribution, we are getting operating profit. So can I say contribution is equivalent to profit plus fixed cost? If contribution minus fixed cost is operating profit or profit, then can I say contribution is equivalent to profit plus fixed cost? If fixed cost just changes its side, of course. So we have got two methods of finding contribution. One is sales minus variable cost. Another one is profit plus fixed cost from this income statement only. So again, I'm moving forward to the next slide where I have incorporated the list of formulas. So these are the two formulas, sales minus VC and EBIT or PBIT. This is the profit portion plus fixed cost. Now, so if someone asks me in an interview, what is basically contribution? So contribution is also a kind of a profit. Contribution is also a kind of a profit which covers up what expenses? Only the variable cost of a company. That is known as contribution. So contribution is a very, very, very important parameter in marginal costing. Why, sir? Because as I have already explained in the first few slides, that in marginal costing technique, fixed cost is basically a period cost. It has no role in decision making. Only variable cost are basically product cost. They are very relevant in decision making. So therefore, if fixed costs are not considered and if contribution considers or covers up only variable expenses, so contribution becomes a very important parameter under marginal cost. Next, we move forward to the next set of formula, that is PV ratio or C slash S ratio. If you just remember the name PV or C slash S, you will get the formula. Sir, how? PV ratio means profit volume ratio, which is also known as C slash S ratio. That is contribution sales ratio. As I have already said, if I say X per Y or XY ratio, that means X divided by Y. If I say Brazil Argentina ratio, then Brazil divided by Argentina. If I say Germany Ecuador ratio, Germany divided by Ecuador. This is basically a simple concept of ratio analysis. So similarly, if I say contribution sales ratio, then contribution divided by sales. PV, profit volume ratio, profit divided by volume. Now over here, profit means the contribution part only. As I have already explained previously, contribution is also a kind of a profit which covers only variable expenses. So contribution divided by the volume of sales will give us basically PV ratio. So we can see the formula, contribution divided by sales into 100. Now, if we have two different years or two different time periods, then will this formula be valid? Because of course, in a particular time period, you will have only one contribution. You will have only one sales. But in two different time periods, you will have two contribution, two sales. So in that case, will I have two PV ratios? No, I will have only one PV ratio. So PV ratio is constant until and unless there is change in the sales or the selling price per unit. So if there are two contribution or two sales in two different time periods, what will be the formula? The formula will more or less remain same. Just there will be a term called delta or change. So it will basically be change in contribution or profit divided by change in sales into 100. So whatever we had previously, contribution divided by sales into 100 will become change in contribution divided by change in sales into 100 in case of two figures or 2 years. Now, I will try to explain one thing, how we are getting change in profit from change in contribution. Okay, so for that purpose, I'll use Canva. So we are studying PV ratio, right? So what we have observed, that it is basically delta. Delta means what? Change in contribution by change in sales into 100. Now, From the income statement only, we know that after sales minus variable cost, we get contribution, which I have repeated many times. Contribution minus fixed cost will give you profit. So, in place of contribution, by taking delta as common, can I write contribution is profit plus fixed cost, that is EBIT plus fixed cost. Just now I have explained under the methods of computing contribution. Because contribution minus fixed cost will give you profit. So profit plus fixed cost will give you contribution. So I am just breaking it down. Divided by delta sales, that is change in sales, into 100. Now, one important observation over here. If I break this bracket, what will I get? Change in profit plus delta, that is change in fixed cost, divided by change in sales into 100. In a particular time period, as I had already explained, fixed costs will always remain same. So there is no possibility of any change in fixed cost. So basically, this figure, change in fixed cost, will be zero, nil. So again, I am recalling the thing that I have said previously, that fixed cost is a period cost in marginal costing. It has no role in decision making. So change in fixed cost is zero. So finally, what we are getting, delta profit plus zero divided by delta sales into 100. That is change in profit by change in sales into 100. That is why it was written over there that basically change in contribution is also known as change in profit in case of PV ratio. It was mentioned in the slide. I hope the explanation is crystal clear. Now I'm moving forward. Okay. So basically, so we have already covered up the formulas of contribution. We have also covered up the formulas of PV ratio, both the formulas for one data of contribution and sales and for two data of contribution and sales for two different time periods. Finally, we are moving forward to the formula for calculating basic sales. Sales. So sales, one method is very clear that if contribution is sales minus variable cost, then sales will be contribution plus variable cost. If contribution is equal to sales minus variable cost and if variable cost will go to the other side, then sales will be contribution plus variable cost. That is a very normal concept. Another thing that we can see over here is that sales in amount is contribution by PV ratio. Sir, how is it happening? From the formula of PV ratio only. If PV ratio says, if PV ratio is contribution divided by sales into 100, so sales is in the denominator. So if sales is cross multiplied with PV ratio, then we have PV ratio into sales equal to contribution. Now PV ratio comes down to the other side. So we have sales equal to contribution by PV ratio into 100. So from point number A of PV ratio only, we are deriving the formula of sales in amount. So whatever we are seeing is just basically a consolidation of whatever we have done in the income statement. So that is why I have given the name master table, or you can say Brahmastra. Brahmastra of finance in management accounting, also in finance, in FM, also financial management also. This is very, very, very relevant. The income statement. So basically, PV ratio contribution by sales into 100. So sales will give you contribution by PV ratio. sales in amount. Next, if we find sales in units, it will be contribution divided by contribution per unit. Sir, how will we remember that? First thing is that whether we find sales in amount or sales in units, in both the cases, the numerator is same. What is the numerator? Contribution. The denominator is changing. In case of amount, it is PV ratio. In case of units, it is contribution per unit. Sir, why it is contribution per unit in case of units? Because in case of amount, how PV ratio is coming, we have already explained that it is coming from the formula of PV ratio. But in case of units, why are we considering contribution per unit? So let us again take an example using Canva. So basically, first of all, I'll wrap it. The thing was
Just open the pen section.
okay. Which sections? Sorry,
Yeah. Oh, yes, yes,
editing,
you are. Yes, draw section
draw.
from where you are selecting the pens. Yes, right. Click on
This
this.
one, right?
Yes. From
This one.
below, third one. This one.
Uh,
This one.
okay, fine. So as I was discussing regarding the formula of sales, so what we have seen over here that sales in units is basically contribution divided by contribution per unit. Again, I am writing sales in units is basically contribution divided by contribution per unit. Now, I'll just explain why it is happening. For example, if I say that I have gone to a market to buy some mangoes, right? And I am buying few mangoes from the shopkeeper. So casually ask the shopkeeper that how much profit you have earned. So let us consider, just for the sake of this example, let us consider the profit to be contribution in this case. So the shopkeeper says that, sir, I have earned a profit of around 1,000 rupees today. 1,000 rupees. Then I asked him that, okay, please tell me that what is the profit rate per unit? How much profit you have earned by selling each mango? On one mango, how much profit you have earned? So if it is uniform, if the profit per mango per unit is uniform, is same, then the shopkeeper will say me, for example, the shopkeeper says, I have earned around 10 rupees per mango. That is my profit margin. If the shopkeeper says that, then I can easily find the shopkeeper has totally earned a profit in a day of 1,000 rupees. The profit per unit, that is the profit per mango, is 10 rupees. So how many mangoes he has sold? 100 mangoes. That is the sales in units basically. So sales in units is basically contribution divided by contribution per unit. That is the profit part divided by the profit per unit. So how many units I have sold? 100. That is sales in units. So I hope the concepts are clear. Next, I will move forward. I'll again go back to the slide. Next, I'll move forward to a very important concept, that is break-even sales. To explain the concept of break-even sales, I'll again go back to the slide of income statement. Okay. So Under income statement, what we have seen, that what is the preliminary level of profit? The preliminary level of profit is operating profit, that is PBIT or EBIT, profit before interest and taxes, or earnings before interest and taxes. This is the preliminary level of profit. So at break even point, there is no profit and no loss. We know that very well, because break even point means a point where there is neither any profit nor any loss. So this operating profit will be zero. This is only possible if contribution and fixed cost are same. Let us again go back to Canva so that I can explain the concepts properly. So basically we know that contribution from the income statement only minus fixed cost will give you profit. That is the EBIT, right? Now if I say that my profit is zero, because at break even point my profit is zero. In order to make the profit zero, there is a basic rule. Both the contribution and fixed cost shall be same, because 2 minus 2 is 0, 3 minus 3 is 0, right? If we change the figures, for example, if contributions figure is different than that of the fixed cost, then of course you will get a different profit, right? Either a positive profit or a negative profit, that is a loss. So in order to make the profit zero, the figures of both contribution and fixed cost needs to be same. That is very clear. So can we write that at break even point BEP, contribution is equal to fixed cost? It's a very simple concept that we have understood, right? Okay. Now I will try to deduce the formulas. On one hand, I will keep sales, the formulas of sales. On the other hand, I will keep the formulas of break even sales and I will compare them. Basically, whatever I am teaching all of you is basically a buy one get one free offer. So if you know the formula of sales, automatically you will know the formula of break even sales. I'm trying to teach in that manner. So sales, first of all, in amount. What is sales in amount? Just now I have covered up contribution divided by PV ratio. From PV ratio only we are getting sales in amount. This is in amount. So I am just giving the rupees icon over here. Now sales in units. Contribution divided by contribution per unit. These are the two formulas that we had covered up just now. Now, under break-even sales, again we'll find break-even sales in amount and again in units. So first of all, let us found in amount. Contribution PV ratio. We know at break-even point, contribution is only fixed cost. Again, I repeat, at break-even point, we have understood that contribution is equivalent to free cost. So instead of contribution, can I write fixed cost? So break-even points amount formula is fixed cost by PV ratio. Rest of the things will remain same. Only contribution will be replaced by fixed cost. Again, in units, what will be the formula? Just the same thing. If you understand the concepts, the formulas will become very easy. Contribution will again become fixed cost divided by contribution per unit. So I have just kept both the formulas side by side to give you a clear idea that if you understand the formula of sales, you will clearly be able to remember the formula of break-even sales, because contribution is only replaced by fixed cost As I have already shown you that as per break-even point, profit is zero, so contribution will be equivalent to fixed cost. Okay. I hope this concept is clear and both the formulas of break-even sales are also clear. Next, I'll move on to the concept of margin of safety. That is my next topic, margin of safety. Then again, I'll go back to the slide. Now, as the term suggests, margin of safety, MOS, it is actually margin of safety sales, MOS. It is basically the additional sales over and above the break-even sales. As we have already discussed, what is break-even sales? It is the sales that is required to at least cover up my expenses, the cover up the expenses of the seller. So at break-even sales, there is no profit, no loss. But if you are selling something more higher than the break-even sales, that means you are earning certain amount of profit. There is a profit component. Then that additional sale is known as margin of safety. In order to remain safe, the business needs to earn certain additional, the business needs to generate certain additional sales in order to earn profit. That additional sale is known as margin of safety in order to be safe. Because if a business is earning from sales, whatever the business is just spending, the business is spending 8 lakh rupees, and the business is also selling goods worth rupees 8 lakhs, then of course there will be neither any profit nor any losses. But how long the business will be able to survive? The business needs some profit. For that reason, the business needs to generate more amount of sales. That additional sales is known as margin of safety sales. So from this formula only, I will deduce another formula which is very much relevant and very much used in marginal costing. Total sales minus break-even sales. Just now we have seen the formula of total sales in amount is contribution by PV ratio. Again from the formula of PV ratio. We have seen that. And again, in case of break-even point, contribution is equivalent to fixed cost. So instead of contribution, what will we write? We'll write fixed cost. So it will become fixed cost by PV ratio. Next, we'll just take an LCM of that. So PV ratio in the denominator and the numerator, we have contribution minus fixed cost. And we have already studied in the income statement what is contribution minus fixed cost? Operating profit, right? Operating profit or EBIT. That is the preliminary profit. So we are getting the formula MOS equal to profit by PV ratio. A very, very, very important formula. MOS equal to profit by PV ratio. What is the problem with the students? Normally, whenever they go through this chapter, they try to mug up all the formulas without understanding. But if you read in such a manner, if you study the concepts in such a manner, because whatever I am teaching you without seeing anything. I'm just trying to deduce one thing from another concept, from the basic master concept of income statement. So if you go through that income statement properly, you'll be able to understand and remember all the formulas without any hassle. So MOS is basically profit by PV ratio. So if can I say if someone asks you a technical question in an interview, a basic question rather I shall say, if PV ratio increases and profit remains same, if PV ratio increases but profit remains same, in such a situation, margin of safety will decrease. Again, if profit remains same and PV ratio decreases, then margin of safety will increase. So we have got a very important or a very basic link or relationship between MOS, margin of safety, and profit volume ratio. So I'll come back to my slide. I'm taking a lot of time so that this one lecture would help you out in understanding all the basic concepts of marginal costing. That is why I'm taking so much of time. Now, I come back to the slides basically. We have covered up contribution, PV ratio, sales, break-even sales, and finally we have also covered up margin of safety sales, which is clearly visible in the screen. Total sales minus break-even sales, and I have shown you how to find from total sales minus break-even sales EBIT or profit divided by PV ratio, right? So next we have few practice questions. Okay, so we have few practice questions. So first question we can see, if PV ratio is 60%, marginal cost of the product is rupees 20, what will be the selling price? That is the first question. Before going to the questions, I'll again go back to Canva to give you more concepts. So basically, first of all, I try to give you a concept of income statement only, but in a different way. We know sales minus variable cost gives you contribution, right? So can I say that sales is equal to variable cost? If the variable cost changes the side plus contribution, we can easily say, right? So sales segregated into two parts. One portion is the variable cost percentage on sales. Another portion is the contribution percentage on sales. Now we have already covered that contribution percentage on sales means contribution divided by sales into 100. That is profit volume ratio, PV ratio. So just see, just from a single income statement, how many formulas we are deducing, we are understanding the impact, and we are connecting those things with the concepts, and how will we solve the problem sums of today by using this concepts only, because in books you will find a different method. Okay. So sales equal to variable cost plus contribution, and it is basically segregated in two parts, the variable cost percentage on sales and the contribution percentage on sales. So it is basically the percentage of sales. So if I say my sales percentage is 100%, and what are the two portions of that? Variable cost percentage on sales and contribution percentage on sales. That is the PV ratio. So if I say my sales percentage is 100% and my variable cost percentage is 40%, then what will be the PV ratio? The remaining part, that is 100% minus 40%, that is 60%. Right. On the other hand, again, if I say that my sales percentage is 100%, which is always 100%, we are assuming, and my PV ratio is 30% only. My contribution to sales ratio is 30%. Then what will be the variable cost percentage on sales? The remaining part, that is 70%, because both are coming out of sales. This is a very important concept that we will utilize soon. Okay. Next, let us go to another concept, that is the concept of angle of incidence. The concept of angle of incidence. So for that purpose, I'll be drawing a graph. So we have two axes over here. So let us measure the output in the horizontal axis and the sales, cost, everything, all the amounts in the vertical axis, right? So we'll start with total sales. We have also done these things in economics. Let us consider this as total sales line, TS. Now we'll draw the cost lines. So cost, again, considering two types, fixed and variable on the basis of behavior. So fixed cost, as we know, can never start from origin. Why? Because fixed cost can never be zero, right? There will always be a certain amount of fixed cost. So fixed cost starting from this point. This is the total fixed cost line, TFC. Now we will have variable cost. Now with the change in the units, fixed cost always remains same. That is why fixed cost is not increasing. It is a parallel line. But if the units change, there will be change in variable cost. That is why variable cost will change. Variable cost line will never be parallel. So let us draw a variable cost line, supposedly, like this. This is a Let us suppose that this is a total variable cost. Now we have the fixed cost. We have the variable cost. Okay. Or let us consider for our betterment that this is the total cost. Okay. This is the total cost. We have a fixed component, we have a variable component, and by adding those, we are getting total cost. So this gap in total cost and total fixed cost is basically total variable cost, because TFC plus TVC will give you TC. That is why TC is above the TFC line. Total cost is above the total fixed cost line. Okay. Now we can see that the total sales line, the TS line, has intersected with the total cost line and has formed an angle over here. I think the angle is visible. This angle is known as angle of incidence. The angle between total sales and total cost is known as the angle of incidence. So, if the angle of incidence is more, then of course the firm is earning better profit because the firm is selling more. The firm is generating more sales compared to the cost that the firm is incurring. If the angle of incidence is lower, that means the total sales is very close to the total cost. The firm is earning lower amount of profit. So angle of incidence is directly proportional to the amount of profit the firm is earning. Now we'll see one thing over here also, that at this point where total sales and total cost line is intersecting, we can say at this point total sales is equal to total cost. That means there is no profit, no loss. So this point can be referred to as break even point, BEP. And again we can draw a perpendicular line from that point to get break even sales units and join the other part of the perpendicular line to get break even sales in amount. So basically this is a chart where I have shown more or less all the concepts of marginal costing. And above this break-even sales, whatever sales the firm is generating, that is known as margin of safety sales. So basically, this gap is also known as margin of safety because this is the amount of profit. So to earn that amount of profit, the firm has to generate the MOS, that is the region above the break-even sales. So suppose if the firm earns this amount of sales or generates this amount of sales, then of course, what will be the profitability percentage or the profitability portion? This will be the profit. So I've just given you a basic idea diagrammatically that how marginal costing works or what are the various components of marginal costing. I hope it is clear. Now I'll go back to the sums. Okay, one by one. I hope I am being able to make you explain all the concepts, basic concepts of marginal costing because I am not going into depth. I'm not going into absorption costing, difference between marginal absorption costing because this is a preliminary class, a basic lecture that you are getting. So I'm just explaining you the basic concepts. So again, I'm going back to my PPT. So we have a set of practice questions. So question number one, PV ratio is 60% and marginal cost of the product is rupees 20. What will be the selling price? So basically, let us start the question. What is the information that we have? PV ratio is 60% and marginal cost of the product. Marginal cost of the product is rupees 20. So we have to find the selling price. Now, what are the methods of doing this sum? We can use the formula and do it in a layman's way. Contribution by sales is PV ratio equal to 60 by 100. Marginal cost actually means variable cost. Marginal cost means variable cost, which I have already explained in the first few slides. So we can do it also in the form of a formula. But if we use a simple concept that I had already explained you just few minutes ago, then you can just solve it in few seconds. So let me use that concept. We know PV ratio is coming out of the total percentage of sales. I have done it just few minutes ago. That sales minus variable cost will give you contribution. So sales equal to variable cost plus contribution. So sales percentage equal to variable cost percentage on sales plus contribution percentage on sales. That is PV ratio. So if PV ratio is 60%, can I write variable cost percentage on sales is 40%? Just now I have explained. PV ratio means what? Contribution percentage on sales. That is PV ratio. If the proportion of contribution of sales 60%, what is the remaining proportion? Because sales is 100%. That is 40%. That is the variable cost percentage on sales. Now we know the amount of variable cost. We also know the percentage of variable cost. So can I say that 40%, that is the percentage of variable cost on sales, is equivalent to the amount of variable cost? That is rupees 20. Now we have to find the selling price. Now sales is the superset. From sales only you are finding out PV ratio and variable cost percentage on sales. So sales is always how much percentage? 100%. What has been asked in the question? To find out selling price of sales. So if we find the value of 100%, then we'll find the sales in one line only. So 20 just by applying unitary method divided by 40 into 100. So half into 100 will give you rupees 50. This will be your selling price and the answer for your first question. So just see, just by applying simple concept, And logic, we are just finding the amount of sales without any hard and fast formulas and anything. Just applying simple concepts we are finding out. Because from sales only you're getting PV ratio and VC percentage on sales. So sales is 100%. So if PV ratio is 60%, the remaining percentage will be variable cost percentage on sales. That is 40%. So 20 rupees is the value of variable cost. And the percentage is also given. So if 40% is equivalent to 20, then to find the value of sales of selling price, that is 100%, you have to find the value of 100%. That is by using unitary method, 20 by 40 into 100. I hope the concepts are crystal clear over here. I'm rubbing them all. I'm moving to question number 2. I hope all of you are enjoying the session because I always try to teach out of passion. It is not like just reading the text out of book. Okay. I always try to find out new concepts and to correlate those concepts with whatever I am learning on a day-to-day basis. So I hope all of you are enjoying the session. Next, question number 2. A certain profit when sales is rupees 2 lakhs, fixed cost 40,000 and break-even point 1 lakh 60. So let us again go back to Canva. Sales. So we have sales rupees 2 lakhs, fixed cost 40, fixed cost rupees 40K, that is 40,000, and break even point, I think it was 1 lakh 60. Let me check it once. Yes, 1 lakh 60,000 rupees, 1 lakh 60. So again, this break even point means break even sales. So this is basically the break even sales, rupees 1 lakh 60,000. Now you are required to find out what? To find out the profit. Okay. We know break even point means fixed cost by PV ratio. That is a break even sales since we have it in amount. So that is fixed cost divided by profit volume ratio. We draft it like this. So in place of break even sales, we'll put 1 lakh 60,000. In case of fixed cost, we'll put 40,000, that is 40K. And we don't know the PV ratio. So in the next step, cross multiply, we'll get PV ratio equal to 40,000 divided by 1 lakh 60,000. So eliminating all the zeros, we are getting 1 by 4. That is 1/4 is how much percentage? 25% is the PV ratio, 1 by 4. 25%, 1 by 4 into 100. This is your PV ratio. We need to find out profit. Now, we know PV ratio means contribution by sales. So can we write if PV ratio is equal to contribution by sales, so can you write contribution equal to sales into PV ratio? Very important concept. And I have already explained this. Sales into PV ratio. What is the amount of sales? 2 lakhs. Into PV ratio is 25%. So what is 25% of 2 lakhs? 1/4 of 2 lakh is 50,000 rupees. So what is the amount of contribution? 50,000. Now we have to find profit. We know profit means, or basically profit over here means the preliminary profit, that is operating profit or EBIT. So profit means contribution minus fixed cost. So we have the contribution 50,000 We have the fixed cost 40,000. So what will be your profit? 10,000 rupees. 10k will be your, this will be your contribution minus fixed cost. Contribution is 50,000 minus fixed cost is 50,000. I hope the concept is crystal clear to everyone. Again, I am repeating, the first step will be using the formula of break-even sales, fixed cost by PV ratio. Why are we using the formula of break-even sales? Because the value of fixed cost is given, right? So break-even sales amount is also given. So we'll find the missing link, that is the PV ratio, which is 25%. Now, by multiplying that PV ratio of 25% with the sales amount, we'll find contribution. Now, by deducting fixed cost from contribution, we'll get the amount of. Okay. And moving forward to the next sum. If you have any doubts in whatever portions that I am explaining, you can comment in the comment box
Thank
later
you
on.
so much, sir. I don't think after this detailed explanation and all the examples, there is any doubt. Okay, thank you so much, sir, for your wonderful session. I hope we will get your session in the upcoming special lecture also.
Okay, 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 okay.
Thank you so much, sir.
Thank you. Thank you. Thank
Thank you. With this, we are concluding today's session. Okay, sir.
you. Okay.
Okay.